Hey everyone, it is Evan here from the Trade Risk on Friday, March 13th, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and finish off looking at some sector analysis. So it was a tremendously busy week. Once again, we had a month's worth of headlines all compressed into just what seems like a few days worth of trading. We had two circuit breakers this week. We had a VIX jumping to, I believe, as high as 77. We had a 25% drop in oil in a matter of minutes. S&P 500 extending its gains from, or its pullback from all-time highs, and maybe pullback isn't the right word, but 26.92%. So lots to talk about here. We're going to try and make some sense of this action. Let's start it off with our market technicals dashboard here. You can see we got a monster move to the upside into the bell here on Friday. You can see all of the major indices closing anywhere from 6 to 9% up on Friday. And notice, even with the magnitude of those gains, look at the 5-day change numbers, still have double digits in two of the major indices. IWM still 17% down over the past 5 trading days. Truly remarkable at just the size and speed of the moves that we've been seeing. We are below all of the key simple moving averages in the major indices. Now, if we scroll down and take a look at sectors here, everything is in the red. Technology at the top of the list, followed by healthcare and staples. So a little bit of a defensive tone there. I mean, technology certainly not usually seen as a defensive tone to the market, but I think for this particular market catalyst that is causing us to sell off, it does seem like tech is in sort of the safe haven bucket. On the downside, energy 25% over the past 5 trading sessions, followed by utilities and materials. Now, in terms of major markets, we see the VIX still up 50%. I didn't get to, we'll take a look at where that closed. Not sure what the figure was there, but still up almost 50% of the week. Natural gas and the US dollar at the top 3, only green major markets there on the week. And on the downside, it was oil, it was silver, and it was emerging markets. So let's jump into the charts here with the S&P 500. So we're looking at the cash settled market of the S&P 500, and we're looking at a weekly time frame. And basically here you can see just the size, the sheer size of the moves that we've seen over the past 3 weeks, just completely overwhelms all of the trading that we've seen over the past year or so. Just in magnitude here, we have completely erased months worth of gains in just a handful of trading sessions. So the S&P 500, you can see clearly getting a bounce off of the lows. So a little bit of saving grace here into the end of the bell, but still with all of the technical damage that has been done, it is very early, premature to say that the bottom is in, but we are certainly due for some type of bounce or reaction move to the upside. But really, before we even go any more detail in the technical analysis here, you can see that the S&P 500 made it almost all the way back down to the lows seen in 2018. And a couple of ways to look at this here. First, if we look at the Dow, which we don't usually look too much at the Dow here, but we can see the Dow eclipsed all of the lows here from the past year or so. We got all the way down to, at least in the Diamond ETF here, down to 211, which brings us back to levels seen in 2017. And again, this is in about 2.5 weeks worth of trading. We totally erase about 2 years worth of gains. So the Dow suffering a pretty large retracement, pullback, fall, collapse, whatever you'd like to call it. The Russell 2000, even greater in its magnitude here. You can see totally losing and closing below the lows here from 2018. And we're back to that big old range that we traded in the 2014, 2015 sort of era. You can see coming all the way back down to about under 110 here in the IWM Russell 2000. That's good for about almost a 36% fall off of the highs in about 2.5 trading weeks. So quite remarkable there. And lastly, if we look here at the NASDAQ composite, you can see doing a little bit better on a relative basis. In fact, a lot better on a relative basis, because if we look here at the extent of the NASDAQ, we got as low as just under 7,200. Notice that only brings us back to basically February of 2019. So it was a much more contained, even from a longer term perspective, this is still a brutal fall here in the past 2.5 weeks for the NASDAQ, but well sort of kind of in line with some of these big shakeouts that we've seen in the past here for technology. It's off roughly 27%, which again is a huge move, but holding above and still in line with lots of the progress it's made over the past 12 months. So that, just at a high level, I think is good perspective there to see just exactly where we've come from and where we sort of have been. And if we really think about the S&P 500 here, we'll just use this as our proxy for just the overall market. But if we actually throw on a yearly chart here of the S&P 500, notice that, we haven't yet even fully retraced all of last year's gains. We had a monster move last year. We're up 29% in the S&P 500, putting us in one of the best, certainly the top percentile of yearly gains for the U.S. stock market for the S&P 500. And notice, we're basically back almost doing a full retrace, but haven't done it yet. So, if we think about where this market still has the potential to go, again, keeping the big picture in mind, if we are, of course, really going to price in a recession here and just lots of slowdown, lots more fear and quarantine and all of the headlines and uncertainties that we're dealing with right now, you have to ask yourself, is the lows from last year, should we be actually even deeper than a retracement, a pullback, or a bear market below where we started from last year? And again, that's not to instill fear or to say that we should be down there. It's just an open sort of thought exercise here, as we always try and do, is just outline all of the possibilities here, and just help us make more informed decisions as a trader. So it's something to think about here, that if we are in fact going to be pricing in just a much slower, dire environment than where we started last year, where should the market be trading? Or, the flip side is, of course, we have totally overblown this, and this is a 25% pullback miracle to scoop up stocks at extraordinary cheap prices. Those are obviously your two extremes, and if you want to try and figure out that thought exercise, that's what we're trying to do here. But as traders and technical traders here, let's try and put some levels to this. So if we switch over to our other view, which I think is, this one here, you can see 26.92%. That's the pullback from the highs here. We got all the way down to about 2485, and then the lows down around 2400 from last year. Those are the levels below us. So those are what I'd be looking at here. And on the upside, we've basically just sliced through all of the support, or potential support, on this downward move. So when we start thinking about retracement levels, we of course have this big old gap that we would potentially look to fill here from Thursday. So if we were to actually close that gap, you're looking at all the way up to about mid 2700s or low 2700s, I should say, if we are going to fill that gap. So basically, based on where we closed, that would give us about approximately another 5 or so percent just to fill that gap. We'd still be, even with another 5% rally after today's 5% move. Let's see if the future's settled in. Let's see what the SPY looks like. Let's look at the SPY here. So sometimes TC2000 doesn't have that updated prices yet on the cash indices, but if we look here at the SPY, you can see with this 9% move, we did nearly fill this gap here from Thursday. Notice though, right where we are now, we're still kind of bumping up against the slope at which we've been selling off here. So getting follow through next week, I think would be a change of character here. If we do get some upside follow through on Monday and we can actually hold it, I think that would actually be our first real meaningful change of character. And if we can start holding above 272 or so, that brings us back over this 3-day low here that attempted to hold in early trading this week. So I think that is a good first effort here by the bulls to potentially stop the bleeding and put in some type of reversals. If the S&P 500 can get follow through next week, hold above 273, I think that would start to give us some confidence that at least the dip buyers are starting to come in here and, scoop up prices around these levels. So that's what I'd be paying attention to there for the SPY. And I think, really just looking at the SPY here, I think is going to be the best course of action. I mean, we could draw out similar levels here on the Russell. The Russell is just clearly notably weaker. So notice it didn't quite even get into the gap here from Thursday. It's still well below the downtrend line here. It's got a series of kind of breakaway gaps to the downside. So, very similar comments apply though, getting follow through, filling the gap, getting back above the trend line, the slope at which we've been selling off. I think, that would all be constructive, behavior. And same thing for the Qs though, which is again, what has been holding up better. I think getting follow through, getting back above this little cluster of the Monday through Wednesday lows, which would basically be in the Qs over 196, let's call it, or 194. 194.50. If we can start getting above there, getting follow through, closing above there, I think that would start to make some progress. So that pretty much covers, I think, all of the, at least the shorter term levels there. If we look at the VIX, you can see, yeah, we definitely got the VIX backing off here into the close, closing down at 60, which is still a remarkable thing to even be saying, that the VIX has pulled off and has cooled off, closing at a 60. It just goes to show the times that we're in right now, but certainly well off of the 70 plus nosebleed highs for the volatility index. Last but not least, the one thing I did want to try and prepare for today, but just got swamped, was some of the breadth metrics here and just some of where we stand in terms of stocks trading below or above like a 200 SMA or 50 SMA, or looking at 52-week lows. And we are seeing, almost record extremes in some of those readings, actual record extremes, not just, multi-year extremes, but the number of stocks trading at new 52-week lows is something I'll try and post later after this video, but they are at, to say the least, washout levels. And again, I think, into the bell here on Friday, you're seeing some of that snapback here, which is sort of taking place. So that covers, I think, all in all about the markets. The only other comment I'd want to make here, as I've sort of been reiterating, is with the VIX up here at 60, was formerly 70 plus, we do have to, again, be aware, and I think this is the broken message I've been saying here over the past couple of weeks, is that the ranges intraday should be large. I mean, that is what the VIX here is telling us, and essentially a 5%, 6% up and down day range just in a given S&P 500 day is the new normal. So, closing up, closing down 5%, or doing several round trips intraday, that is the normal. That should not be a surprise right now when the VIX is up here at, 40, 50, 60 plus. So just keep that in mind. Again, risk management is certainly above all else the most important thing you need to keep in mind, which obviously, and I'm sure this week has shown us all. So let's move on now to some other major markets. We'll go to TLT next, which on the week here, oh, that's a monthly view, on the week here had a very loud sort of exhaustion reversal week, if you will, down 7.69%. You can see we opened up the week just shy of 180, and we closed the week down around 154, 8% move, just a massive move here for TLT, historic in its range as well. It was, extended last week, it was extended to the upside the week before, and the open this week was even more extended, right? So finally we got the rubber band snap back to reality. We're starting to come back down to which is even a steep trend for TLT, but still kind of coming back down into this weekly trend line here. So might even have some more to go, but into the lower 150s or so. I think that's a reasonable spot to kind of retest upper 140s, lower 150s to sort of retest the August breakout, or the highs, the breakout to above the 2019 highs, and this trend line here. So we'll see if we can get dip buyers to kind of step in there. But TLT, putting in a very loud week here, and maybe that was the blow off here in rates in this 30-40 year cycle in lower rates. We'll have to see, but for TLT anyway, putting in a very noticeable week there. If we look at gold, also very noticeable here and some very bearish action. Actually, let's switch over to this view. What did I have here? Yeah. So if we switch over to this window here and we look at gold, you can see once again here an outside reversal week, kind of a bearish engulfing week here on the weekly time frame, and we're really engulfing like this whole year's worth of trading to the downside. So this action here in gold, I think, should not be ignored. I've been largely on the bull side here for gold, but I think this is a week to sort of take notice and reassess that plan. To me, I would look at gold here as a potential candidate that's going to be on its way back down into the mid 130s. I wouldn't be surprised to see follow through here over the next several weeks, back down to the lows here from late 2019, and that I think is where we'd have to see if some of the longer term buyers are going to show up there for this metal. So gold, I think, is in a little bit of pain here. Again, in the short term, might be due for a bounce. You might get some reaction back up to 150, but then I think you just need to be cautious there. Long-term trend is still up, but I think the high volume engulfing action here over the past several weeks, the vol expansion, is not something you really want to see in cool, calm, collected uptrends. So got to be careful here in gold. I think it's telling you something there. And silver, I mean, very loudly telling us something's not right here in silver. A 15% move. I didn't actually run the study here, but this has got to be one of the top percentage moves here for silver as well, going all the way back many years. It must rank in the top 5-10% of single days or single weeks, I guess. That was the weekly chart. The daily chart here was a 6.5% move to close out the week. You can see it coming all the way back down to the 2019 lows. So, same thing with silver here. Very stretched to the downside right now. So, of course, some type of reaction back up. But to me, it looks like we're back on the way to 13, retesting the 2019 lows. And we'll see if silver bulls can step in there and buy that. But some very rough action there out of the metals for this week. I think we did see, of course, the culprit here is the U.S. dollar. At least the dollar index here today really blasting off, and that puts a lot of pressure on commodities, metals trade, and lots of other things. So the U.S. dollar really getting quite a big move there. And again, this is just the dollar index, which I think is mostly against the euro. So where were we? So energy, I think, was the last one here, and energy, of course, being the huge story this week. Oil down 21%. You can see in USO just basically making new lows here. I'd have to look at the futures contract to get some more clarity there on a longer term basis, but just totally obliterated here on some of the price wars that are going on, or supply wars that are going on. You can see down 25% on Monday of this week, obviously adding more pressure and stress to the financial system. And you can see it just spent the rest of the week kind of going sideways here. So lots of damage here. It's certainly, kind of broken, oversold right now, dislocated, whatever word you want to use. But, something where day trading it probably makes sense. Swing trading it seems, like a crazy thing to do right now, just given the big moves there. But, in terms of energy, I think natural gas actually is more interesting here just because it is holding up. It didn't continue to break down or blow up with oil. Of course, two different kind of reasons why. So there's some, natural reasons why that wouldn't be the case, but I still think it is constructive here that natural gas is holding up. I do think this is interesting. Back over 1520, I think this could actually start to move here. It's been very difficult to call any type of meaningful bottom in natural gas, but I'd pay attention to it over 15 and a quarter or so. I think it could really get a good move all the way up into the high teens, 18, 20, in a fairly short order. So that's it. That's all of the major markets. If we take a look at sectors here and just take a quick peek at what's performing best, what's on the bottom. Top performing this week again is energy. We're just going to look at weekly charts because frankly, the moves are so large. It's kind of how you have to view these things. But XLK again on the week was down 5.5%, but still gave it, put it in the top spot here from relative strength. You can see it did undercut briefly this $80 level, but notice, it is sort of holding on to longer term structure here. In fact, you could almost argue that this was a very violent undercut and retest as the way we came slamming back down. But we did close back above it. And, from a longer term perspective here, XLK actually looks pretty decent, trading against this week's lows or trading, $79 or so. The longer it can hold above there, it looks like XLK just got a very fast, harsh reset. And I don't think it's necessarily going to just be a V shape, but, it does look like it's trying to hold on to some structure there. So XLK, do like it. XLV number 2. So this is healthcare defensive tone to the market. Down 6.62%, but again, you can see this is holding structure, kind of came barreling down into the lower end of this range where all of this prior supply was. And actually, this is a position that we do own. So XLV was a purchase here by our Merlin trading system. So we do have exposure outright in the XLV. So this is a current long holding. So we're looking for higher prices here. Again, don't expect it to be a V shape. This is a patient hold that we could be in for some time. But we do own some here, on this sell-off, looking at that as opportunity to get involved here in a more defensive area of the market. So XLV, do own it, and XLP, in fact, we do own this outright as well in our Merlin trading system. So we picked up this late in the week as well, consumer staples. And again, both of these kind of make intuitive sense here as markets seem to be more risk off, more defensive to get equity exposure, which we don't have a whole lot of. The equity exposure we do have are in the defensive areas of this market. So XLP, we do own this position as well. And it was the third top performer this week. A little more of a harsh reset here, but you can see clearly coming back into the meat of sort of this range here for the past several years. And you can see a nice aggressive rebound so far. Again, still could take plenty of time for it to really catch its footing in those particular sectors. Now, on the downside, energy, XLE getting totally slaughtered, mostly off the move of oil, 25% down. And of course, XLE was already in a pretty rough sort of position. It's down 63% over the past year and a half. So XLE hasn't really gotten any love anytime in recent history. So you have to be careful there. But again, if you're interested in trying to play for that mean reversion, or if you're looking for a more tactical snapback, obviously there are companies in there that are probably getting sold indiscriminately. So there is opportunity there if that's your skill set. But I certainly have no clarity on what companies would be doing better and should be not priced or getting hit as hard. But if you do have a skill set there, if you want to dig through balance sheets and see exposure and all that fun stuff, then there's probably opportunity right now for value plays in XLE. Last but not least, XBI here, second worst performer this week. It was holding up for quite some time until this week. So XBI was acting as a very great kind of beacon of relative strength, but it did get destroyed this week. We had a position in here. We were stopped out this week, so we did own the XBI up here, and we were just basically washed out of this. So no longer have a position. Again, back to the lower end of this range, has a lot to prove. Last but not least is utilities. Utilities, just the tying into rates here make this a little difficult this week with some of the knee-jerk reactions. You saw, of course, the chart of TLT and some of what fixed income land did, so some pressure here in XLU, but pretty violent sell-off, 14%, huge move for XLU. Again, probably some opportunity here if you want to dig through, comb through companies, things that shouldn't be sold off as hard, but again, not my skill set, so I really have to just kind of step aside and let this play out. So that's it. That is the recap for this week. There's lots to go through, even more that we didn't talk about, but it was a very busy week out there. So again, this is very unique times here in the market. So congratulations to everybody who made it through. If you're watching this video, you survived. I don't necessarily think we're out of the woods entirely yet, but maybe the worst of it, the fastest component of it and the speed is over, but I will not definitively say that by any means. So that's it for me. Thanks as always for tuning in and watching. Every Friday, every Tuesday, market recap videos just like this. You can subscribe on our YouTube channel or follow us at The Trade Risk. Have a great weekend. We'll see you back here next week.